Me Jun, a member of the American Stockholders University, protects the rights of American stock investors. Let's start today's United States stock market news for May 19th. As always, I am Mi Jun, your steadfast guide in the fundamentals of United States stock investing, here to greet you today. Mi Jun's fellow value investors, I hope you all had a relaxing weekend. Last weekend, I spent some quality time with my family, went out for a drive, and also had a meaningful day relaxing at home. I think I need to tell you about that experience. Recently, Nvidia Jensen Huang's official autobiography was published in Korea. The title of the book is Nvidia Jensen Huang, the Man Who Creates the Future. I also recommended this book, so I have some personal feelings about it. The author of this book is Steve Witt, and he spent a lot of time with Jensen Huang to write this biography. He also met with many Nvidia officials and conducted several interviews, so he was able to provide a comprehensive account of what makes Nvidia such a valuable company. Now, I have some very interesting news that I want to share with all of you. This time, I had the opportunity to conduct an exclusive interview with Sweet Lang. Even without knowing much, if you just look at the main stock in Nvidia, you can tell that the real star is not the chief executive officer. That's why many subscribers who watch this channel with us are investing in Nvidia and continuing to hold their positions. So, through this Steam It Live, we can take a closer look at how Nvidia investors are feeling and get more detailed insights through our in-depth interviews. Is this an interview broadcast with Stephen Witt? I will make sure that the interview is delivered to you at 9 a.m. Korean time tomorrow, May 20th. So tomorrow is the United States stock market news, which is less important than today. I will make sure to share the more important interview with Stephen Witt with everyone. It would be great if as many people as possible could watch this broadcast together. This is the pre-recorded Bing 2 news for May 19th and will begin right away. This is Monday's broadcast. Last week, I covered the current events in the United States and China. On Friday, the United States and Chinese markets went up again. If you look at the upward trend that continued for 5 days, the S&P 500 last week looked like this. Most of the sectors are marked in green, showing that the market has expanded significantly. Also, some very specific parts are clearly marked in green, indicating strong growth. Nvidia rose more than 16%. There were many stocks that surged like this. This is also a very positive upward trend for the tech-heavy Nasdaq, which we are paying attention to. As expected, the Nasdaq 100 rose by 6.80%, recording the biggest increase among the major indexes. Second, Micron Technology, a small-cap stock, rose by 5.63%. The S&P 500 also rose by 5.29%, showing a good upward trend. Next, I will show you the performance by sector for the 11 sectors. Last week, all 11 sectors that make up the S&P 500 closed in the plus, outperforming the index. If you look at the top, technology rose by 7.95%. Second, consumer discretionary stocks in the United States rose by 7.54%. Third, the economy-sensitive industrial sector rose by 5.64%. And then, communication services, which are greatly affected by the economy, including companies like Google and Meta, also rose by 4.73%, making it one of the best performing sectors. Now let's take a look at the highlights of the market over the past week. As you can see, it increased by 77.7%. If it rises slightly more, it will be overbought, indicating the extent of its recent increase. The S&P 500 consists of 500 major companies, and more than 77% of them have turned into short-term bullish trends. Currently, the market is showing a very strong upward trend, and even the medium-term trend is now exceeding 55% of stocks turning positive. Next, let's take a look at the bond yields. Bond yields continued to rise last week, but now they seem to be stabilizing and showing signs of a rebound. It went down to 19.72. Until recently, it was forming below the 200-day moving average, but now it's different. Looking at the market opening on Monday can provide insight into the direction it's heading and give a sense of where things are going. The detailed content will be delivered a little later. Next is fear and greed. Last week, it went up from 70 to 71, and now it's showing a direct upward trend without any significant correction. And the maximum score for the Kosdaq is 78, which it reached again. 78 means it's at the level of extreme greed, so it's hard to say that the Kosdaq is going down right now. The market has entered a very overheated state. It is a time to pay attention to the potential correction of stocks that have been overvalued, and that's my assessment. Let me read it a little more carefully. Such overheated phases can come before a drop in stock prices. Therefore, instead of aggressively buying new stocks, it is time to manage risk by securing cash and reducing exposure, according to the report. I also tried to include my personal opinions in this review. The article stated that the recent 23% surge in bullish sentiment suggests the next stage will likely be more challenging. Previously, I said that you can't move momentum to volume, and there is a reason why I said that. Therefore, if you want to predict the current market's turning point, I personally think that it's not really necessary to make overly conservative investment decisions. So whether you buy stocks that have value or try to time the stock market, I don't think that's really necessary. But at the same time, you shouldn't be impatient and try to buy stocks at a cheap price when the market is moving too fast. Thus, the investment period is now shorter, and investors can realize profits much more easily. So, in the short term, small corrections are possible. That is my personal judgment. Well, to sum up, that's how it's been so far. We've been focusing heavily on the mid to large cap stocks. But from now on, it's clear that the minimum investment amount you set as your goal and the level of cash holdings you maintain should be secured. That's just my personal opinion. Next, I'll briefly review the performance of last week's United States stocks. Last week, most of the United States top picks performed strongly. Among them, the stock that showed the best performance was Nextracker. It surged by 27.4% in just 1 week. However, last week I presented the earnings results in advance and then suggested a more conservative guidance. As a result, the stock price fell 3.7% on the announcement day and continues to drop by 2.23% in after-hours trading. Celestica was the second stock that garnered significant investor interest with a steep 21.7% increase last week. Third, looking at the stocks with the highest returns, Credo Technology had a plus of 18.37%, Tesla was up 17.34%, Nvidia was up 16.07%, Vista was up 15.37%, AMD was up 13.93%, Uber was up 10.84%, Palantir was up 10.42%, Taiwan Semiconductor Manufacturing Company was up 10.03%, Broadcom was up 9.80%, Talon Energy was up 8.75%, Meta was up 8.08%, the Trade Desk was up 7.42%, and Amazon was up 6.49%. Bitcoin rose by 2.21%, bringing its current price to $63,230. B2 was up 1.53%. Lastly, strategy stocks showed a modest minus of 3.9%. Now today I think we need to talk about Tesla here. Tesla's stock price has soared nearly 45% in just 1 month, and as a result, investor interest in Tesla stock is rising. Now, I think it would be helpful to read this article quickly. Tesla's Relative Strength Index measures the degree of overbought or oversold conditions. When it records 71.4, it enters the overbought range. Of course, 71.4 is not that high. There are many stocks that go up to 75 or even 80. Let me explain again about the number of previous cycles. Relative Strength Index is an indicator that measures the magnitude of recent price changes to determine whether a stock is overbought or oversold. We look at two things when making a judgment. First, how long the stock price has been steady, and second, how long it has been volatile. When the Relative Strength Index exceeds 70, it indicates that the price has risen too rapidly and excessively. That's how to interpret it. And when the Relative Strength Index value exceeds 70, you should be cautious because the price could drop due to overbuying. On the other hand, if it falls below 30, it means the price could rebound due to overselling, so you can make your judgment based on this. Now, there's one important thing here that I want to share with you. In the case of Tesla, if you look at the chart, you'll see that Tesla's Stock Relative Strength Index started to exceed 70 at the end of December 2024. It was just before the sharp rise, and at that time, the stock price was at its all-time high of $479, but after that, it turned downward. So after the Relative Strength Index exceeded 70, last time the stock price dropped significantly. And then, in March 2025, there was also a time when the Relative Strength Index dropped below 30, and after that, Tesla's stock price showed a sharp rise. So there are stocks where the Relative Strength Index doesn't work well, but in the case of Tesla, when the Relative Strength Index goes above 70, it tends to fall, and when the Relative Strength Index drops below 30, the stock price tends to rise. Statistically, this pattern has been observed, so you can check this part. Now, regarding Tesla's stock price, on May 12th, if you look at the daily chart, it went below $315, and this can also be interpreted as a sign of strong buying interest at that time. The middle Bollinger Band is the moving average line, and the upper band is set at 2 standard deviations above the moving average, while the lower band is set at 2 standard deviations below the moving average. That's exactly it. So if the stock price keeps going up and touches the upper band, as you can see here, when the price hits the upper band like this, it means there is still room for the price to rise. And if it falls below the lower band, it usually means the price is oversold. So if you look at Tesla's stock right now, you can see the relative strength index, the Bollinger Band chart, and the overbought and oversold signals all together. This is how the indicators are organized. Tesla's stock has risen for 6 straight trading days, but the upward trend appears to have stalled today. And then on Friday, it went up again. This time, the cumulative return for the rally has increased by about 15%. Now, this time I looked into Tesla's stock valuation with Joyce Sustang. Personally, I am very interested in Joyce Sustang's evaluation of Tesla stock. The reason is that among the stocks that Joyce Sustang often recommends when the market is volatile, Tesla is one of them. Previously, even Representative Kim In-jong mentioned this system. There are stocks that it predicts well, and on the other hand, there are stocks that it doesn't handle as accurately. So for Tesla stock, both the buy signals and the sell signals are captured well, and it tends to show a relatively good performance overall. So right now, how the market is evaluating Tesla stock can be considered one of the most important indicators for understanding the current situation. Now, as you all know, on April 29th, a buy signal appeared for Tesla stock. At that time, Tesla's stock price was $285.88. If that's the case, the return so far is about 22.4%. The current SMART score is 63. Therefore, since it's in the top 19% overall, fundamentally there are no issues with this company, so I think it's reasonable to evaluate it this way. However, if you look at the side here, there's one thing that doesn't look so good. The valuation is high compared to its peers, and the fair value is $266. So right now, from the current viewpoint, Tesla's valuation is considered high. Let's take a look at this point again to see if we need to consider buying. Now let's take a closer look. After Tesla stock entered the overvalued range, it continued to rise even further. Now, if you look at the chart here, this part shown in dark blue is the fair value. If the price goes above this line, it means it's overvalued, and if it falls below, it means it's undervalued. So as you can see here, even after entering the overvalued range, there have been quite a few periods where the stock price stayed high for a long time. And then, after the stock price dropped, it eventually rose again from the middle range. Eventually, after hitting the bottom, it moved into the overvalued range again. This kind of movement is possible. Is that right? While no buying signal has appeared yet, if momentum improves as expected, a buying signal could likely emerge on the choice stock. This scenario is anticipated. Next, I'll show you the momentum indicator for Tesla stock. Among the 26 indicators, 4 are showing a sell signal, 6 are neutral, and 16 are showing a buy signal. Overall, the outlook is positive. You can see it like this. Now, let's take a look at Tesla's one-year stock price chart. Currently, you can see that the stock has broken through a very important resistance line and is moving upward. That resistance line was at 326, so now that resistance line will act as a support line. So, even if there is a technical adjustment in the short term, as long as it doesn't fall below $326, there is a high possibility that the upward trend will continue. You can look at it this way. I will briefly go over the performance of Sion Mulji before the Monday market opens. Dow Jones is minus 0.79, S&P 500. Futures are showing minus 1.18% and Nasdaq futures are down 1.49%. Last week, the 3 major indexes which hadn't shown any minus during the week are all showing a sharp decline. It's because there was some bad news. I will first deliver the news about the United States National Credit Rating downgrade that was announced over the weekend. Moody's Investors Service announced after the market closed on Friday that based on the government's fiscal deficit over the past 10 years and the current high level of national debt compared to other countries with similar credit ratings, the United States credit rating has been downgraded from the previous AAA to AA1. For reference, Moody's is one of the world's top 3 credit rating agencies. And these credit rating agencies not only rate each company, but also continue to update the credit ratings of each country. However, the United States had its national credit rating reduced by 1 level, as shown here. So Moody's, Standard & Poor's, which we call S&P, and Fitch, these are the 3 major credit rating agencies. Previously, only Moody's had not downgraded the United States credit rating and had maintained the AAA rating until the end, but this time they finally decided to downgrade it. This part is very negative. Investors don't seem to think this downgrade will have a big impact on the market, but they are showing a short-term reaction. Truist stock prices coming out as the market opens. This decision is not a game changer. If you look at it, there has already been a lot of reaction from both institutions since the adjustment, so you can see it this way. However, it could serve as a signal for investors to act. In the last month, stock prices rose over 20%, leading to concerns about a potential short-term correction and the risk of falling stock prices. This measure is also being monitored closely for its potential to broaden the investor base. The 2017 Inheritance Tax Law Amendment has drawn even more attention. Currently, TRIMF is working hard to reduce interest and instead pay taxes, but whether paying taxes is the right thing to do is a question that can be raised. The succession of the Orion Group's economic troubles has been brought up again. It's a historical event. The market impact will be limited according to evaluations. Let's listen to a more detailed explanation directly. Moody's has been maintaining its stance, pointing out that the United States government and Congress have not been able to reach an agreement on fiscal deficits and interest expenses that have continued for the past several years. They added that it will be difficult to fundamentally reduce the fiscal deficits and debt in the current political environment. According to Moody's, United States government spending on interest payments is expected to account for about 73% of total government revenue in 2024, and this is projected to rise to 78% by 2035. They announced this projection. And also since 2017, when the temporary debt ceiling law was implemented, there was a set period for the debt ceiling, but it could be extended if necessary. They announced that over the next 10 years, excluding interest expenses, the federal government's fiscal deficit will increase by about $4 trillion. So that's what Moody's says. They say that over the next 10 years, if the government continues to run a deficit without balancing its income and expenditures, the fiscal deficit will inevitably increase. They are warning that if this continues, the government's fiscal deficit and public debt will inevitably rise. So in fact, the government is currently working on tax reform. If taxes are raised, 2 effects will occur. First, since tariffs are collected a lot, the government's revenue will increase. And there's another effect as well. If tariffs are raised, in the end, in order to avoid tariffs, many factories will need to be built inside the United States. If that happens, industries within the United States will become more active, and the possibility of the United States industrial sector reviving will increase. So, in this way, the Trump administration is working hard to increase government revenue. We can see their intentions through these actions. After 2021, as national revenue rises, this trend is expected to persist. We should note this point. Let's focus on one key point. In the past, it was a period of low interest rates, so even if we had a lot of debt, the interest burden was relatively low. Now, if you look here, this is the interest payment amount. In 2021, it accounted for about 9% of total income, but by 2024, that figure has risen to 18%. If this trend continues and the ratio keeps increasing, by 2035, it could reach about 30%. This situation highlights our grim prospects. So, if the government spends 30% of total income on these benefits, that means only 70% is left. If that happens, the government's funds will continue to dwindle, potentially leading to a very negative scenario. Moody's concludes that the United States will inevitably face a decline in its economic and financial credibility, making it more challenging to stimulate the economy through fiscal policy. This time, I will also reveal Moody's conclusion. Moody's announcement was made after the market closed on Friday. That's why the stock market was already closed. And more importantly, the bond market was also closed. So we couldn't see the market's reaction. That's what it means when the article says it was after the market closed. Well, but then the bond market opened again on Monday. Now, first of all, the bond market's direct impact is very important, and it's necessary to keep this in mind. The reason is that, due to this announcement, the United States national credit rating could be downgraded. If that happens, a national default could occur, and if a national default happens, the price will fall and the yield will rise. The country's credit rating could be downgraded, and if that happens, the negative impact on the stock market could increase. This is how we could imagine the situation. But right now, in the bond market, the United States Treasury yield has actually gone down. Surprisingly, the interest rate has dropped significantly. The 10-year government bond yield has risen to 4.54%, increasing by 0.105 percentage points in a short period. And the 30-year government bond yield has gone up to as high as 5.023%. Analyzing the current high volume of transactions in the bond market can provide insights into the prevailing economic situation rather than mere speculation. But personally, I think S&P and Fitch had already adjusted the United States credit rating before this. Therefore, just because of this downgrade, I personally think that the ability of institutions to sell United States government bonds will not decrease significantly. That is my judgment up to this point. So the interest rates are rising, but we need to keep an eye on whether these high interest rates will continue. What I think is most important is not the grade downgrade itself, but the economic indicators that will be announced after the downgrade. The United States economic indicators that are coming up are mostly hard data, and the soft data hasn't been very good. The reason is that politically the numbers have continued to come out poorly since the downgrade. The important thing is whether it's consumer price index, personal consumption expenditures, or employment reports. These are hard data that we can actually measure. Looking at these numbers is important to get an accurate assessment. The trade deficit with China has been reduced thanks to the agreement. If positive economic indicators can have an impact on the market, I personally believe that this time the interest rate cut will not have as much of an effect on the stock market. Now, this week in the United States stock market, there are several major events that our investors need to pay attention to. Among them, the most important event is the Computex event, which opens in Taiwan on Monday, May 19th. Computex, with the theme of artificial intelligence, NEXT, is scheduled to be held for 4 days. On the first day, if you look at the main keynote schedule today, you can see that Jensen Huang, the Chief Executive Officer of Nvidia, is the keynote speaker. Now, Jensen Huang's speech has just ended. I have summarized only the most important parts so that I can deliver them to you in several sections. The most important content. Nvidia unveiled new technologies to maintain its lead in artificial intelligence. Breaking news is being delivered. Jensen Huang, the Chief Executive Officer of Nvidia. On Monday, at the Taipei event, Jensen Huang opened Asia's largest electronics exhibition, Computex, and introduced updates on the generative artificial intelligence ecosystem. He also announced that he would further strengthen partnerships with major companies in the supply chain. Nvidia is working hard to strengthen its position at the center of the artificial intelligence boom, especially in areas where data center demand continues and investors and business leaders are paying close attention. Also, the government of Trimfor is responding to concerns from the global semiconductor industry about the supply and demand of key materials and the impact on manufacturing. Now let's understand this context. So, in this event, I'll briefly summarize only the most important points about what was structurally announced. First, Jensen Huang, the Chief Executive Officer, he announced that the next generation GB300 system is scheduled for release in Q3 this year. It hasn't been long since the GB200 came out, but the upgraded GB300 will be released in the third quarter. That's really welcome news. This is an upgraded version of Grace Blackwell, the top model currently used by leading cloud service companies. Jensen Huang announced it that way. During the keynote, he also thanked many partners, including Taiwan Semiconductor Manufacturing Company and Foxconn. So GB200 is the top model right now, but if the upgraded GB300 is released, the price will go up, right? Will the new one be even more expensive? If the price goes up, we can expect Nvidia's incredible profit margins to continue, or maybe even get even higher. And there was one more important announcement. It's NVLink. MV Link Fusion. Let's take a look at this together. It allows customers to directly combine CPUs and NVIDIA artificial intelligence chips, or to use NVIDIA CPUs and third-party artificial intelligence accelerators together, providing a flexible computing system. It's a structure that creates a whole new ecosystem. In the past, systems were built only with self-made components, but now, through open architecture, data center operators can choose and combine what they want. Yet NVIDIA still dominates the core. That's how you should see it. And in reality, Marvell Technology and MediaTek are also planning to introduce their own advanced reduced instruction set computing machine, based development with MV-Link technology. To explain this a bit more, Marvell Technology has been making custom GPUs for major tech companies for a while now, and now NVIDIA as technology can be used in this custom field as well. It means that a whole new ecosystem is being built. So going forward, it's not just about using only NVIDIA or only using chips developed in-house by big tech companies. So you can enter NVIDIA's ecosystem first, like this, and then you can switch to other platforms or later chips. A processor that works together with NVIDIA's accelerator, this is what we call a central processing unit. So even in central processing unit S, NVIDIA has its own Grace. And Grace is not just used alone, but is used together with the Grace Blackwell. The central processing unit can also use Qualcomm's core and Fujitsu's core. Now, among the various ecosystems, we only need to choose one that we have, and that's how we proceed. Therefore, the market is less likely to expand further. That's my personal judgment. Just as major customers like Microsoft and Amazon are driving the development of their own processors, NVIDIA is also actively developing its own ecosystem and expanding its partnerships to maintain its leadership in the semiconductor market. This trend was clearly evident in today's announcement. And that's what stood out even more. The small form factor system DGX SuperPod and the DGX Station were also announced. NVIDIA announced this summer that the L40S graphics processing unit will be widely supplied to local partners in Asia, and the previously included Dana H100 graphics processing unit will still be provided. Now, in the picture here with me, this is the chip with me. This is a supercomputer called SPARC. SPARC is a supercomputer with extremely high performance, but the problem is that it consumes a huge amount of power. So not only people like us, but also engineers who work from home or in the field can now have access to such a small supercomputer. However, the price remains high. NVIDIA is now entering the PC market too, which is essentially what's occurring. Here with me is the DGX Station. You could even call this a PC. With more affordable pricing, individuals can now set up a supercomputer right on their desks. That's how you should view it. So here with me are both products. Both of them used to be data center only, Grace Blackwell architecture, right? If not on a desktop, it can be expanded to an edge environment, lowering the position of the cloud and supporting on-site rapid development and deployment. Now, you don't have to access the cloud. You can implement artificial intelligence on just the PC you have, and that's how it works. Now, besides that, today there were various announcements like digital twin, robot simulation, artificial intelligence factory, and DGX cloud. Among them, I think the most important part is the digital twin robot simulation. Now, let me explain why. When we think of artificial intelligence, we usually just imagine chatbots or software applications. But in the near future, artificial intelligence will have the ability to go beyond just software, even into hardware. We usually call this physical artificial intelligence. Robotina exemplifies autonomous driving. Here, the digital twin with me means that we are looking at the artificial intelligence embedded in such hardware once again in a virtual world. What kind of problems there are, how well it works, and whether it can produce effective results in various environments. Instead of actually building and implementing something like this robot, we continue to run the digital twin in this virtual world. So before actually constructing the hardware, we create the most ideal model possible and then proceed with production. That's how it works. Therefore, as the era of physical artificial intelligence approaches, it is my personal judgment that the value of these kinds of digital twin universes can be fully realized. Through various presentations today, I want to remind everyone once again that NVIDIA's artificial intelligence leadership cannot exist without NVIDIA's own hardware. The title of the next prepared article is Magnet 7, the most anticipated in 7 years. If you check directly how much the Magnificent 7 stocks have fallen, I think you'll find it helpful. According to Goldman Sachs, the valuation of the Magnificent Seven Group has fallen to its lowest level since 2018. Apple, Alphabet, Amazon, Meta, Microsoft, Nvidia, and Tesla. These are the 7 stocks we call the Magnificent Seven. By the way, the expected earnings yield for these stocks over the next 12 months, which we refer to as the forward price earnings ratio, is at a very low level. Based on this forward price earnings ratio, the combined figure is about 28 times. Compared to the 7 companies, the other 493 stocks in the S&P 500 have a forward 20. About 43% is being traded as free float shares. Compared to other stocks, it's trading at a staggering 43% premium. That's why we must be cautious and keep this in mind. Now, if you actually look at the premium over the past 10 years, there have been times when it exceeded 100%. That was probably at the end of 2021 and in 2013 as well. The premium went up to nearly 100%. The reason for this is that among the stocks in the index, while the price-earnings ratio of COTG was as high as 30 times, the average price-earnings ratio of the remaining 493 stocks was only about 15 times. So there was a gap of about 2 times, with the PERs ranging from 15 to 30 times. But now, if you look at these numbers, the gap has narrowed to about 40%, so the relative valuation gap has decreased a lot, and now the gap is quite narrow. You can see it like this. In fact, over the past 10 years, David Kostin is telling us that the relative premium has averaged about 30%. So, is there a background for why the valuation of this group of megacap stocks has recently dropped? Let me organize it in 3 ways. First of all, the biggest reason is concerns about artificial intelligence investment. This is because as the risks become more visible, concerns are naturally arising. Secondly, there's the risk of trimming pressure, potentially causing a sharp drop at the end. Recently, we've received a lot of positive feedback, so it's possible that some of the rise was due to this reason. However, the median value of each sector is more influenced by fundamental factors such as profitability and financial soundness, rather than being determined by the cross-section valuation model, which is based on the basic fundamentals. Therefore, although there are many reasons behind it, it is possible to conclude that the current situation is relatively restrained despite the concerns. Now, what about David Kostin? Compared to the S&P 493, the Magnificent Seven's relative performance risk is increasing on both sides, he explains. What does this mean? This indicates that the company's valuation has decreased considerably in the short term over the past 2 years, and the appealing real position has vanished. After the official announcement in Q1, interest in artificial intelligence investments has revived. Most mega-cap stocks had already increased their artificial intelligence investments by then, and this trend persists. An important point to note. So the atmosphere is getting better again. The momentum of the Mega 7 stocks can be used as a catalyst. However, currently in the United States and Europe, the decline in semiconductor, Apple, Microsoft, and Meta stocks is rapidly dragging down the overall market. Therefore, if these antitrust lawsuits continue, it could put downward pressure on stock prices. And also recently, when Apple announced plans to develop its own artificial intelligence-based search engine, Apple's stock price dropped by 7%. This means that within this group, competition is becoming increasingly fierce. Therefore, this means that within this group, or within the Magnificent Seven, there is a risk that increased competition could actually lead to changes in stock prices. That's the conclusion I'm drawing. Now, let me summarize the story of Hanmadi from the United States. In conclusion, when I look at the data, the Magnificent Seven stocks are currently the least diversified they've been since 2018. In addition, investors' interest in artificial intelligence is still alive, so investment demand is actually increasing. Well, but there are also some concerns. The first is the ongoing anti-dumping investigation between the United States and Europe, and the second is the growing economic uncertainty within emerging markets. So while some companies will succeed, others may fall behind. Especially in the rapidly changing era of artificial intelligence, the Magnificent Seven companies could either rise to the top or fall behind, depending on how they adapt to these new technologies. Therefore, the competition for artificial intelligence among the Magnificent Seven is expected to intensify even further in the future. So, by following the Magnificent Seven, we can see which companies will succeed and which ones will fall behind. This way, we can predict the outcome. But about 5 years ago, on July 13th, 2020, there was a video I shared. In the first 10 minutes of that video, there was something I said. As megatech competition intensifies and the market expands, one company can benefit from this change. Despite challenges in the semiconductor sector, this company remains a top recommendation, particularly as artificial intelligence investment competition among megatech companies intensifies, just as it was 5 years ago when the market began. So the answer to the question is this company. This is how you can benefit from the artificial intelligence boom. And this stock is probably obvious to many of you, but it's Nvidia. I watched this video about 5 years ago. But even now, there are still a lot of comments coming in, like from 3 years ago, 4 years ago, and 2 years ago. People keep leaving comments like this. Let me show you the most recent comments. As you can see, even today, several people are still leaving comments. This is from the United States. Is the answer Nvidia? For those who left comments 3 days, 5 months, and 6 months ago, keep commenting. This is the latest hint video from the United States, and here's how to view it. Everyone, if you watch this broadcast, you'll be able to relax for a while. Nvidia's house price 5 years after the forecast is now accurate. So if you watch this video about how I evaluated Nvidia 5 years ago, I think you'll like it. May 19th. This is today's big news in news. Thank you for joining us for the first broadcast of a new week. As you can see, it's Monday, so there are lots of orders that have been delayed. Earlier, as I showed you, the Monday Futures Index is dropping significantly. To lighten the mood a bit, we've invited an optimist to today's video. Tony will be looking ahead at the United States stock market and sharing his predictions, so we hope you enjoyed today's broadcast. Let's all keep investing in United States stocks together until the day we retire. Have a happy day, thank you. The next guest is considered more advantageous from a risk management perspective than before the start of the bull market. The guest's name is Tony Latt, a consumer news and business channel reporter who is currently with us in Miami. So how is that possible? If you look back at last February, when the market hit its all-time high, there was a lot of uncertainty about the future, and no one was looking ahead to 2026. But now, the enthusiasm related to interest rates is much lower than it was back then. And when we look ahead to 2026, whether it's the completion of regulations or tax reductions, right now we're moving in line with interest rates. But by then, there are positive factors such as the possibility of additional interest rate cuts that we can look forward to. From an industry perspective, I personally think this situation was actually a black swan event. From the stock market plunge to the shockwaves of the economic downturn, companies are facing a reality that exceeds their expectations. This was the most stressful test I've ever experienced in this business environment. If you put all these factors together, it is said that the market is more likely to rise in the next 6 months. You are looking at the outlook for 2026, but aren't you giving up on the rest of this year? Yes, there are still many unresolved issues left from now until the end of the year. However, the recent rally in the stock market was largely driven by investment positions and psychological factors. At that time, when the index dropped to around 60, many investors were forced out of the market without being able to withstand it, and even when the market rebounded afterward, cautious investors couldn't easily increase their risk again. So currently, since overall investment exposure is low, even a small adjustment in the market can have a relatively large impact. Investor sentiment indicates that funds continue to flow into safe assets. That means investors who had been cautious until recently are just now returning to a more neutral or optimistic stance, so there is still room for further upward movement in the market. The United States stock market index is also showing a more optimistic trend, and the market is positively evaluating the policy shift by the Federal Reserve. However, I still acknowledge that the possibility of maintaining the current trend is low. If the 30% tariff on China and the 10% tariff on other countries continue, wouldn't that still be a negative factor for the economy? Now we are living under the new tariff system, and industries are also making adjustments accordingly. In the current market, one of the most important lessons is that we are now in a position where we can observe how companies adapt to these complex adjustments over time. There was certainly confusion at the supply end, but the stock market has already absorbed much of that and is showing signs of stabilizing. As you said, we are now in a time when consumers are becoming more sensitive to the prices of essential goods. However, this doesn't guarantee a higher price-to-earnings ratio for semiconductor stocks or a bullish market. Now, this is a reality that we have to accept and manage. What do you think about the outlook? I think the steady upward trend in the market is a good sign. The reason for the rise in long-term interest rates may not simply be due to inflation expectations, but could also be due to changes in the volatility of inflation. This could be a signal for the market to be more cautious. But in my opinion, recently, market commentators seem to be giving overly complicated explanations about why long-term interest rates are rising, rather than trying to be straightforward. Even among market experts, many seem to view this as simply a matter of economic growth expectations, rather than a problem of fiscal soundness, which makes me a bit concerned. But what if, despite all that, the stock market still can't hold up? Wouldn't it be a bit hasty to judge just based on the current situation? If the government doesn't respond properly, isn't there a possibility that the bond market could react negatively? That's right. In fact, there have been similar moments a few years ago. When the national debt situation became unsustainable, many people thought that the United States government's ability to finance itself had ended, which caused panic in the markets, and even the BX index plummeted. But eventually, that moment also passed as just a temporary event. So even if the market shows signs of panic again this time, and everyone says it's the end of the trend, we need to remember that the United States economy is still solid and trust remains strong. The idea that the era of United States dominance is over is, in my opinion, a very hasty judgment when we look at history. And even if those comparisons are somewhat accurate, the current bond market and investors believe that a 10-year Treasury yield of 4.5% or even 4.7% is something that can be sufficiently tolerated. This video contains product placement and advertisements.